And welcome back. Thank you everyone for joining us in today's video. I have Jim Black, the man, the myth, the legend again. Welcome, Jim.
Thanks for having me. Good to see you again, and excited to share some updates on refinancing tools.
In today's video, we're going to talk about if you have an FHA loan, what does it look like to do a refinance? So I'm bringing on Jim Black, who's been a loan officer for over 20 years to provide some insights regarding that. So take it away, Jim.
Thanks so much, Jason. So FHA loans are unique loans. FHA loans are backed by mortgage insurance premiums, and they offer more flexibility in being able to refinance. There are two traditional ways you can refinance an FHA loan. One is just an FHA to FHA refinance, where you have to fully qualify again and get a new appraisal. The other approach, which is a lot more efficient, is known as an FHA Streamline. Streamline is actually a really good word to use for that definition because it saves you time, energy, money on not having to get another appraisal, on having limited documentation. As long as certain requirements are met, the process can take as little as 15 days. So again, if you've been making your payments, if you've been making payments on time, and there's a net tangible benefit, as in rates have gone down by a certain amount, FHA believes you should be able to refinance almost effortlessly. And that's what they call a streamline refinance. I'd love to share some of the guidelines around this, that if you have an FHA loan, you can look at the options of refinancing into another FHA loan, or it might even be possible, if you have enough equity, to get out of that FHA loan and get a conventional loan. Remember, FHA allows you to have a higher loan to current value on the property. Well, if you've had an FHA loan for 5 years and you have more than 20% equity, you may want to get out of that FHA loan altogether. So we'll talk about conventional loans in a next video we have. But right now, we want to really highlight the FHA to FHA streamline refinance. Before we share our screens, it's very important to know that we want to get you the best loan that we possibly can. FHA loans have mortgage insurance that never goes away on the loan. So if there's the ability to get out of an FHA loan and into a conventional loan with no mortgage insurance, that is something to consider. A good local loan officer will be evaluating all the options for you to refinance at the same time. So when we take in an application, we pull credit, we're able to determine the best solution for your needs. So always work with a lender that's looking at both your current FHA to FHA loan, but also look at conventional loans to get you out of paying mortgage insurance.
Absolutely, which means savings to you as a consumer and homeowner. And in a separate video, we'll talk about if you have an FHA loan, what does it look like to refinance into a conventional loan to get rid of that insurance, mortgage insurance.
Exactly. So please share the tab if you don't mind. So these are the kind of net tangible benefit tests that are required to be used in an FHA to FHA loan. So the new term must basically be, if you look at a term reduction, you have to have at least 3 years off for the remaining term, which means you can go from a 30-year fixed down from there. A couple other things that are very important: you have to have a combined savings amount that you can qualify for. If you cannot get a combined savings of more than $50 a month, you can't refinance on an FHA to FHA streamline. You are able to go from a fixed to a fixed loan, or from an ARM to a fixed loan, which means if you had an adjustable rate FHA loan, you can always go to a fixed rate loan. Again, that's more conservative and a better loan for you. In any example, the loan has to meet these guidelines to be able to be an FHA to FHA streamline loan. When we look at this, we're going to go down a little bit farther on this and actually scroll down and show you a little bit more on this here. We will also want to make sure that you have at least 0.5% lower in rate. That is a really key feature also here. So as we're looking here again, you have to have at least 0.5% below the prior combined rate. That's for a fixed to fixed. Under a fixed to an ARM, rate would need to be 2% below that rate you have now. That's a more aggressive way of borrowing money, to go from a fixed stable rate to an adjustable rate mortgage. The other approach is to go from an ARM to a fixed loan. The new combined rate can be a maximum of 2% over that combined previous rate. For example, if I had a 5% adjustable rate mortgage FHA loan, I could go as high as a 7% fixed loan under the same exact guidelines. And the last one is around an ARM to an ARM, an adjustable rate mortgage to an adjustable rate mortgage. That rate needs to be at least 1% below the current or previous rate. Reason being, that savings window is a short-term period of time, either 5 or 7 years. So that savings needs to be higher so that it makes sense for the customer or consumer to refinance. In any of these examples, we are always evaluating FHA to FHA refinance, FHA to FHA streamline, and FHA to another solution that may be of more benefit to our clients. In any of these examples, one credit report is pulled. We collect all the same documentation to make sure we're optimizing that solution. I believe it's a mistake for loan officers not to collect more information than they need. So I always try to get more information than less information. So sometimes if you go with an FHA streamline loan, it's not as much documentation. Well, I think it's important to collect that documentation, because if there's a better solution that exists outside of FHA, I want to make sure that we provide those solutions to the consumer.
Such as a conventional loan, you're saying?
Exactly. Or maybe breaking one loan at 95% into a new first loan of 80% and a new second loan of 15%. There are about 4,000 ways you can structure loans. And so to me, my job as a consultant or advisor is to make sure we present multiple options. And like we mentioned in our previous videos, Jason, it's all about the objectives of the client. Is it a short-term solution where a no-cost option is the most important way of looking at financing? Or is that client looking at the long run, wanting to stay in the property for 10 plus years and get the lowest possible rate they can to save more interest over the long run? In any of those solutions, we always provide a break-even analysis and a total cost approach to looking at what those solutions are and the trajectory of the savings over the life of the loan.
Yeah. Can you briefly talk about that break-even analysis? Because that's probably the first thing that I did before I refinanced my loan through you back in 2021. I was looking at, okay, what's my current payment today versus my future housing payment? You know, what's the cost associated with in order to get that lower rate? And then how long would it take for me to pay off, theoretically, those costs I paid for, you know, getting a refinance? And my window, I think, was like, I want to say it was like a year or something like that. So to me, it made sense because like, oh yeah, of course I want to save money, you know, hundreds of dollars per month. And my break even is like in 1 year when I plan to, at the time, basically live in my house for 30 plus years. So maybe you can kind of talk about that. And also going back to, maybe before that, actually, you're talking about the documentation for Streamline versus conventional. It sounds like what you're saying is that for the conventional refi, you have to get more documentation, more financials from the consumer versus a Streamline. So can you talk about that first? Talk about what's required in order to do an FHA Streamline versus a conventional one.
Sure, absolutely. An FHA Streamline uses the original data on the loan, the original purchase price or refinance value, the original loan balance, to basically do a glorified modification of the loan. You're paying insurance for an FHA loan. You've been making your payment on time. There's a benefit to you to refinance, and it lowers the risk for FHA and Ginnie Mae. So they look at it saying, well, this borrower has a lower loan to value. They've been paying down their principal. We don't care if they have a job increase or decrease. We don't care if their credit score has gone up or down. All we care about is that they've made their payments on time and that the risk of this loan is less than it was when they got the loan originally.
Yeah,
That's
it's
what
not
you
like
look at.
taking money out and having a larger loan balance. Makes sense.
Exactly. Or if you changed a job recently, maybe you went from being W-2'd or worked for a company to being self-employed. A lot of times those qualifications change with the type of income you have. Maybe you had a bonus last year and didn't get a bonus this year. Those things do not matter in the calculations of an FHA Streamline loan. So Streamline truly is faster, simpler, easier. But I believe my job is to always collect more information to make sure that we've looked at all the options available.
Yeah. So if you collect more documentation, such as like your work history, you're talking about your income levels, then if you provide, or if you get more documentation, do you have to provide that to FHA in order to get to the Streamline?
Yeah, more documentation normally means less interest rate. More equals less in a weird, strange way, right? I'm gonna look at that, evaluate with my team, present all the options to the consumer, and maybe they don't want to go through the process of a full blown refinance. Maybe they want to have more convenience and save money faster. They can look at both those options, but I would challenge them to look at the one factor that's different on FHA, which is the mortgage insurance premium. That never goes away. So if we can eliminate $50 to $100 more a month or whatever the number is, that's worth spending a little more time to figure out if we can get not only a decrease in interest rates, but eliminate that mortgage insurance.
Yeah, I think anyone who has an FHA loan, who's a homeowner, has the goal of refinancing into a conventional loan, unless they want to sell their home. Because you can get rid of that
absolutely,
extra payment.
Absolutely. So we look at that, and then again, any option we have, they're all the same credit pull. We're able to lock in interest rates for all the options available upfront to begin with. So what's nice about that is it gives people flexibility to decide what's best for them. And when we talk about break even, like you brought up earlier, we want to look at the break even analysis of any loan that we're doing. Legally, you have to have at least 36 months or less of a break even. Certain programs are even more restrictive than that to make sure it makes sense to refinance. So for example, if it costs $10,000 to save $1,000 a month, that is worth doing because we know the break even is 10 months. So for the next 29 years and 2 months, you're saving more interest for the life of that loan than you were previous to that. If another example where it's cost $10,000 to save $100 a month, we know that that would take over 100 months to break even, or about 9 years. So to me, that's not worth doing because life events happen every day. Maybe you get a job promotion. Maybe you have unexpected twins. Maybe you have to relocate out of the state you live in or city you live in. Things that are longer term to break even, there is more chance of not being able to get. So I like to look at my break even as less than about 18 months is where I like to go, but you can go up to 3 years. So it just depends on our client's goals.
Yeah, I mean, you don't want to spend money on doing a refinance. If you do decide to do the cost refinance loan, which we talk about in a separate video, the no cost versus the cost refinance. But you don't want to like pay money to refinance and then move in 2 years, whereas your break-even point's 3 years. So you're basically losing money on doing a refi.
Absolutely. And let's talk about the best worst case scenario. Yeah. The best worst case scenario would be you refinance today and oh shucks, rates go down another % from where you are. Oh bummer, you have to refinance again and save more money. Oh shucks, like that's not a bad outcome. Trying to time the market to the very lows of the low is very, very hard to do. I was lucky as a professional to time it just by the events I was going through in my life. I got a rate of 1.875. But it was because I was buying a home at that time. It wasn't because I was a refinance guru and timed it to the market conditions. So if it makes sense to do, you can always refinance. And later on, if it gets even better, there are no prepayment penalties, which means you can refinance whenever you want to at any given time. There are no restrictions on that. The government set up regulations to protect consumers, to allow them the flexibility to do whatever they need to do when they want to do it.
Yeah, makes sense. And then can you talk about too the program we're doing or offering right now, these incentives for people who do have an FHA loan or VA loan or a conventional loan, doing a refi, the waiving of the appraisal fee?
Absolutely. So some products don't require an appraisal, just to be transparent. But the ones that do, we're going to cover the expense, which is anywhere from $600 to about $900 additional savings. That's for every single consumer we help, to be fair to everybody. So we're covering that cost. Again, if there is no cost, then there is no cost. So each program is different, but that's just one of the ways we can stand out and try to be more efficient and more effective and try to save our customers more money. Because large banks, their goal is to make more interest, which is not in the best interest of our clients. So we are mortgage brokers. We can work with several different options and go with those lenders that give us the best solutions for the client's need.
Going back to that program of waiving the appraisal fee, when does that expire if you're using Revest loans?
Yeah, so we are licensed in certain states. So please check Jason's site to learn more about what states we're licensed in, first of all. Second of all, we are offering no appraisal fees through the end of 2024. So today is August 6th, 2024. We're going to offer through the end of the year, no appraisal fee refinance for the programs that we offer. Again, you got to qualify to refinance. You have to, meet all the requirements for the lender. We're trying to be fair to all the clients and give them the best options we can and say thank you for the opportunity to help with a large financial event in life. Jason and I both have a passion for doing this, and we would love to be a resource for you.
And thanks for that, Jim. I'll provide a link in the video description below for reaching out to us and also for applying for a loan as well. But I appreciate your time so much, Jim. You're basically a wealth of information. I learned so much from you, honestly. I've been a loan officer for 8 months now, but my main job is being a real estate agent. And it's great to have you on the channel to provide some insights regarding, what's it look like to do a refinance. So stay tuned for future videos. We'll talk about VA loan refinance as well as conventional loans as well. So thank you everyone for joining us in today's video. Hope you guys have an awesome day, and we'll see you in the next video. Thank you so much.